Good morning, Trinidad and Tobago, and welcome to the Bourse Report. Well, the weather may be perfect to pull those covers and stay in bed a bit longer, but today we're covering the two conglomerates on the Trinidad and Tobago Stock Exchange. We're talking about Grace Kennedy Corporation as well as Massy Holdings Limited, both of whom are cross-listed both in Jamaica and Trinidad and Tobago. Now, both groups would have reported modestly higher earnings. Let's take a look at what would have driven that performance and what investors could expect in the coming months ahead. Turning firstly to Massy, we take a look at their earnings per share, and they would have reported for their half-year fiscal 2022, 15.4 cents per share, which is a 3.8% improvement from the 14.8 cents per share reported in the prior comparable period. Now, revenue from continuing operations improved 9.6% from 5.6 odd billion to just over 6.1 billion. Operating profits after finance costs improved less than stellar, 4.7% from 414 to 433 million. Profit attributable to equity holders ultimately improved at 3.9% from 293 to just under $305 million. When we take a look at segment performance of Massy for that half-year period, we can see that there were pretty favorable trends overall from a profit before tax perspective when we compare fiscal 2022, the half-year point, to fiscal 2021. Integrated retail PBT, or profit before tax, increased from 205 to 256, a pretty tidy 25% odd increase there. Gas products also improved in terms of PBT from 122 to 139 million. Again, a 14% increase. Motors and machines posted a fairly noticeable rebound as well, from 76 million to 93 million in PBT, as economies and activities started to open back up once again, and we can see that being reflected in a 23% increase in their profit before tax in that particular segment. And financial services improved just around 6% from 43 million to 46 million in terms of contribution to profit before tax for Massy. Now, from a valuation perspective, well, the stock is a little bit more expensive relative to its historical levels. We can see that historically, Massy has traded at just around a 9 to 10 time multiple of a price earnings multiple for investors. Now the stock is trading inclusive of discontinued operations at 13 times a price earnings multiple, which means investors are paying more per dollar of earnings generated by the company. And excluding those discontinued operations, looking at continuing operations only, the stock is trading at 16-time multiple, so indeed a bit more expensive relative to its historical trading levels, but pretty much in line with the sector average when we look at trailing earnings for the group. Now, at a price of $5.24, Massy is trading at that 13 times PE multiple, including discontinued operations, which is below that sector average of 15 times, but again, excluding those discontinued operations, trading just north of 16 times, and offers investors a dividend yield of 2.8%, pretty much in line with the sector average of 2.5%. Now, on the basis of revenue growth, continuing revenue growth rather, those relatively fair valuations, but with keeping an eye on margin pressures, which would have taken its operating profit margin down from 7.4% to just about 7% for the most recently concluded fiscal period. Bourse is going to maintain a market rating on Massy for the time being. Turning quickly to Grace Kennedy Corporation, or Grace Kennedy GKC, well, the group would have recorded a diluted earnings per share of TT equivalent 8 cents compared to the 7 odd cents recorded in that first quarter of 2021 for the group, 4.2% improvement. Now, revenue from products and services did improve a commendable 15.8% from 1.3 billion TT equivalent to 1.5 billion TT equivalent. Expenses also up by a more than proportionate 16% from 1.3 to 1.516 billion. Ultimately, net profit attributable to equity holders up just around 4.9% from 72.3 million TT equivalent to 75.9 million TT equivalent. Again, Grace Kennedy has confronted higher input costs, and that would have weighed on margins, which we'll discuss very shortly. Profit before taxes by segment, well, some noticeable changes, are very modest 4% increase in that food trading segment in yellow from 64 million to 67 million TT equivalent. Money services was down from 46 to 34 million TT equivalent on account of foreign exchange volatility as well as lower remittance activity. There were notable improvements in the much smaller segments of banking and investments, increasing from 6 million to 20 million quarter over comparable quarter in TT equivalent, and the insurance segment in blue from 4 to 9 million. So we're doubling in that particular segment performance, and almost more than triple increase in profit before tax for that banking and investment segment. Now, when we take a look at GKC's margins, well, the first quarter of 2022 has really bucked the trend that we would have noticed over the past couple comparable first quarters for GKC, with operating profit margins actually falling for the first time over the past 4 comparable periods from 7.5% to 6.8%, and profit before tax margin falling from 8% to 7.1%. And a lot of that has been attributable to rising input costs in terms of those raw materials that go into Greece's products, as well as increased shipping and logistics costs, which have weighed on overall margin profitability for the group. Now, when we look at Greece from an earnings or price earnings perspective, we can see that there has been a steady increase in trailing earnings per share for the group, and its valuations have remained relatively in line with its historical levels at around that 15 to 16 time level there. So investors are still pretty much paying the same as they would for every dollar of earnings generated, notwithstanding the price increases over those past couple of comparable periods for Grace Kennedy's stock. Now, at a price of $5.70, the group is trading, or the stock is trading at 15.6 times price to earnings, which is that pretty much in line with that sector average of 15 times. Not a very attractive dividend yield, 1.5%, compared to the sector average of 2.5%. So on the basis of continued acquisition activity, for which there's a very active pipeline for Grace Kennedy, but keeping an eye on those declining margins and the potential impact of continued financial market volatility on the earnings of the group, Bourse is going to maintain a market beat rating on GKC for the time being. Well, that's it for this week's edition. For more information, you can give us a call at 226-8773, email us at invest@boursefinancial.com, and check out our website where all of our research is absolutely free at bourseinvestment.com. Until next week, stay safe, keep safe in this weather and rainy weather, and we'll see you next time on the Bourse Report.